Worst service in the country. Good food.
Which one's it?
Hi, it's
One corner of the bridge.
It'd be interesting to
it's welcome to the to this IMAP. Welcome to the this IMAP webinar. My name's Toby Potter, and I'm chairman of IMAP, as well as being a national manager of platforms and managed accounts at IOOF, the sponsors of this this webinar series. This series is on the business of managed accounts, and is really thinking about the issues that surround putting a managed accounts program into practice within a dealer group. And I'd like to speak just for a minute or two about the issues which we've found in implementing a managed accounts program. There are really four things which it seemed to me are structural issues which need to be considered in implementing a managed accounts program. The structure of the program itself, whether it's an SMA or an MDA service, or whether one of the other structures which is appropriate, which is available for use in a managed accounts environment, is more appropriate, such as trustee discretion or limited MDA, perhaps an option with limited life expectancy now. For a dealer group thinking about managed accounts, the next thing to think about is the roles that they or other partner organisations might play. Other organisations such as their current platform provider or prospective new platform providers, such as the investment managers which they're used to using, or the investment management capability which they might have in-house. The other issue is the role of the operator or RE, effectively provider of the managed account service, and then the sort of second order issue of who's going to hold the assets. Is this client-owned name, custodial type service? And finally, fit with the advice process. In thinking about implementing a managed account, a fit between the advice process which we currently adopt, or the advice process which we'd like to implement in our business, and the particular type of managed account that you want to offer is critical. So thinking about the investment choice which you currently ascribe to. Thinking about the role of the advisor as manager, or advisor being part of a team of experts, or advisor as a selector of investment management expertise. And finally, the issue of pricing the service in the context of an overall service. And Brett Sanders, our presenter for today, is going to talk in much more detail about that. So these seem to me to be four key issues in thinking about a managed accounts program. In our own case, we offer a number of managed account services within IOOF. We have a managed discretionary account service which operates on a mainstream platform, about 5,000 accounts and about $1.5 billion. We also support SMAs running in Macquarie platforms, and as Panorama or Asset Administrator is rolled out, that's likely to become part of our managed accounts armory, if you like, as well. So we see these as a critical part of our future advice processes, and part of what we bring to both our own licensees and to the alliance partners that we work with. Let me talk a little about IMAP before handing over to Brett. So IMAP is the Managed Accounts Association designed, and its role is really those 3 points that are on the screen: information, education, and representation. So making sure that the managed accounts profession, the advisors, the investment managers, the providers, the custodians, the trustees, the lawyers, the compliance people, have a voice which enables them to work collectively as this important financial service develops. We run webinar series such as this one today. We've also, for the last 3 years, managed and organised Managed Accounts Central at the FPA conference, and we'll be doing that again this year. So this is an opportunity to pull together this year 8 providers or investment managers who can talk collectively but about their own services to the FPA, to the attendees at the FPA conference this year in Brisbane. So this is an opportunity as advisors are starting to think about managed accounts and implementing them in their practice. This is an opportunity to compare and contrast your own service with others in a context of an advisor thinking about the type of managed account that might be suitable for them. As part of Managed Accounts Central, we'll also be publishing a Managed Accounts Handbook this year, basically a set of checklists and thought starters for advisors thinking about managed accounts. There are a couple of spots left in the Managed Accounts Central stand if there are investment managers who are interested. In February, we'll be running Managed Accounts Roadshow. Previous years, Brisbane, Sydney, Melbourne, one day targeted at how we do this in our practice. So, tales from the trenches about implementing managed accounts. And finally, most significantly for me, recently, we're implementing Managed Accounts Directory. So this is a chance for us to provide in the IMAP website a directory of all the participants, and in particular investment managers and providers who have a part to play in the managed accounts world. There's the general advice warning. So what I'd like to do now is hand over to Brett Sanders, who's going to talk to us about pricing models that work. Brett.
Thanks, Toby. Well, good morning, everybody, and Toby, thanks for having me here. I'm going to spend the next sort of 35-40 minutes running through some of my experiences and views on pricing. They're my views, they're not IMAP's. They are born of experience and a certain amount of pain, but they are one set of opinions, and I'll put them out there for your consideration. So, similarly, my disclaimer, the main message here, there's no legal advice, we're not lawyers, and we move on to some basic facts about Philo and our background in this. Toby talked about rolling out a managed account program, and I'm assuming that's the context of interest in pricing, that you're either extending your use of managed accounts or about to introduce them or thinking about it, and where does pricing fit in that? Now, my background in that respect, I spent a number of years helping Centric Wealth design and implement a managed account program. They're already pioneers in managed accounts, but it was a very small part of the business, and we took it from a sort of less than 10% of the FUM in the business to a situation where over 80% of their FUM was being run through managed accounts programs. And part of that program, in addition to looking at issues around, as Toby hinted, advisor role and how you run investment management and the portfolio administration, what's insourced, what's outsourced, part of it was thinking about pricing and making sure that pricing would, there was that opportunity to set the framework for the future at the same time as rolling out this new service mix. That went exceedingly well. It was certainly transformational for that business. As I say, over $3 billion in managed accounts ultimately, and new pricing arrangements that actually helped with the economics, the financial performance of that business in a very significant way. So, have been there, have done that. Pricing, I think, in that sort of program is the most emotional and complex part of the rollout. It is difficult. A lot of the things I'll be talking to today, to me they seem self-evident, having gone through that experience, but they didn't seem self-evident at the time. And so, to me, it's perhaps nothing super profound out of what's being said, but it is born of experience, and I hope that experience can benefit you. All right, we're going to whip through pretty quickly. We'll have time for questions at the end. People who aren't here present in the room are muted, but at the end of the presentation we take it all off mute and we have some opportunity for questions. So, brief overview: where does pricing fit in strategic planning? What makes a pricing model work? Implementation planning, some things you might want to think about, and then and finally some conclusions. My assumptions are, given the way I understand the session was promoted, that people are mostly senior management in a AFS licence holder, that, as I say, looking to introduce or extend the use of managed accounts. Perhaps very aware that platform rebates are a diminishing asset if you still have them at all. Maybe looking to move beyond pure advice to say, can I capture a portfolio management or investment management fee? And maybe also thinking, can I have a pricing model that better suits the mood of the times, that my clients will find more acceptable, that will sort of address their sensitivities a little better than maybe what I'm doing today. Of course, this all varies on where you come from and where you start, and that will be different for everybody on this call. I'm also conscious there's a range of business sizes involved, and we'll touch on some of the implications of that as we move through. So where does pricing fit in strategic planning? Simple message I draw out of this is that the most important is the first point. You can't price your way to success in financial services, in my view. This is not a commodity business. We're not competing on price. We're offering a professional service, and so you've got to address the other aspects of your marketing mix, whether you're doing 4 Ps, 7 Ps, however you look at it. You've got to be very clear about what it is you're delivering to your clients, what the value proposition is, why you are uniquely qualified or you have strong qualifications to deliver those things. And then pricing has to play its part in having a consistent message, but you don't lead with pricing, in my view. So, some fee trends, sort of a practical point really, which we do come back to in a number of ways through this presentation. I look at the broad areas of advice and or activity that you may be charging a fee for, and if we divide them up as I have here, and there are a number of ways you could do this, but if we said, look, you can be providing strategic advice around tax, super, that kind of thing, investment planning advice, how to structure a portfolio, what the right mix is, reviewing that over time, and then portfolio administration and management. If you looked at those three broad styles of service and said, well, how do they rate in terms of how consumers are thinking about fees, my point of view is this. Investors, as fees have become more transparent, seeing that strategic advice, that pricing is they're becoming more sensitive around that. You're competing with accountants who charge on an hourly rate, and I think there is a gravitational pull towards hourly charges, that it is very hard to extricate yourself from that gravitational pull. And so that style of pricing is attaching, has broadly speaking, I would say a 1 times multiple. Those who are involved in trading businesses and things will have, better numbers than me. I'm not an investment banker. But, you're talking about sort of roughly 1 times multiple for a point in time need. You set up someone's strategy for retirement, you may not revisit it again for 3, 4, 5 years. So, this idea that you're going to keep charging continuously for a point in time need, I just don't think it, personally, I don't think it works. Investment planning advice, however, requires regular review. People are sensitive to the fact that, this is where the media actually can work for you, because people see, kind of fear at every turn. They're worried about things, and they, want the comfort of somebody who can help them navigate through that. And they're prepared to pay more for that, in my view. And if the investment planning advice is bundled with portfolio management particularly, then it's easier to justify an asset-based fee. But you have to do it properly. People have to have a sense that in engaging with you, they are getting insight, they are getting information, they are getting skill that they cannot get for themselves. It's, you know, if they find I could read this in Personal Investor magazine, then you're not going to be able to justify the fee. And so it means you'd have to put some real meat around those services. And my personal contention is investment planning is the thing that this industry is weakest at. We're not too bad at portfolio management. We're great at strategic advice around tax and super. We can add a lot of value. But when it comes to structuring portfolios for investors, I think the industry does a very poor job. I think most people end up in the wrong portfolio. And they end up in the wrong portfolio for a variety of reasons, and I think our compliance regime actually exacerbates that problem rather than mitigates it. So if you do it well, you can charge, and that then leads to the conclusion you would want to have less fees if you're looking at sort of overall flow of revenue coming from strategic advice and more coming from investment planning and portfolio management as a general principle. What sort of fees could you actually charge or take a margin on? So not just something you do and you get paid directly for, charge for your own activity, your own sweat, or take a margin on. And I've got a little bit of a laundry list here. So strategic advice, we've talked about investment advice, managed account administration, if you're introducing managed accounts, depending on the nature of it, you may be able to take a margin there. Portfolio management of the managed accounts, so selecting the managers, blending them up, you know, creating sort of default portfolios people can tap into. If you fancy yourself that you can do a pretty good job of that, you might want to have a performance fee that comes with that. If you're a big organisation, you may have your own range of unit trusts, and you may get appointed as the investment manager for those unit trusts, so you could be taking a fee that way. You could have a performance fee on that. You can be taking fees for transactions, some sort of clip on that. Or you may be bundling platform costs in with your other fees. And we see this a bit these days where somebody will say, my investment service, I'm paying the platform wholesale and I'll charge you a rate for those services. And that normally requires some sort of white label arrangement with the platform. So there's a range of fees that are available. Which ones you charge, how you bundle them, is really a function of your business and what suits. So what competencies do you have in your business? What style of managed account are you looking at offering? If you're really talking about an SMA through a platform and you're not actually going to, you're using it sort of, you know, passively as it were, then, you know, what you can charge for will be different compared to if you're creating your own managed account service and you're the investment manager, etc. Do you have the scale within your business to internalise some costs, to run some administration? What do you want to be accountable for? You know, these are complex things to run. The regulatory burden is pretty high. You know, how complicated do you want your life to be? Where do you want to spend your hours in any given week or month? If performance isn't so good and you're the investment manager and you're seen that way in the eyes of your client, you know, how do you go about sacking yourself, or what are you going to do? You've got to sort of think through those things. So that's really about deciding what is the service you want to provide, and then, as I say, which of those fees you start to look at utilising will start to fall out of that process. So pricing that works, that's the title of the presentation. In again, my opinion, the elements that are needed for pricing to work are the following. And we go through each one of those shortly. So, you know, it should be acceptable to clients, sustainable for you and the client, supports the positioning and values of your business, sends price signals to your customers about what you want them to do, limits conflict and aligns interests with your client, provides client choices, and I'll explain what I mean when we get to that one, enhances your business valuation and is easy to administer. So what's acceptable to clients? We've touched on this a bit, but, you know, general theme, I think, as we evolve in this world of pricing. One-off fees for one-off services, ongoing fees for ongoing services sort of seems sort of sensible, but in many cases that's not the way that we're really functioning. The value generated and fees paid have some relationship in the client's mind. You know, if I'm paying this fee, there's a reward there somewhere, and the level of that reward is ideally more than covered. It will more than cover the fees that they're going to pay. Now, you know, what is the nature of that benefit that comes from this new service that you're offering? It should be credible in the client's eyes, you know, that you're offering something. Here's an investment service that's coming from this entity. Is that credible? Are they, you know, they have particular skills? You know, is there a reason why I should expect to get particular insight or benefit from these people? So, you know, it's basically sniff test type issues. The value that clients perceive in pricing, my experience in working with advisors and talking to them about these issues, and in many cases meeting with clients with them to talk these issues through, it can be quite personal. And so you need to understand those motivations clearly. Sometimes it's just, you know, the husband is older than the wife. He's thinking, I want somebody who's going to manage my affairs for me when I'm gone and make sure my wife's looked after, you know, and that's what they're paying for. It's just your continuity and your stickability. It may not be some of these other things. So it is a case of understanding what drives them. A personal view about not putting clients in a corner on pricing, or I'll talk to that when we get to the point about choices a bit later on. Pricing that's sustainable, being for a service where the need doesn't diminish over time, you know, where there's this just recurring need that they have to come back again and again and again, or they're relying on you, and that's what investment markets, you know, a service that connects to markets and how their portfolio needs to respond is useful. And so, you know, we've already heard the advocacy for structuring your fees more around the investment function. You want the service where the client will pay even when the fee is more visible, and, you know, there's been real confidence issues in this industry about value proposition. I've heard people who are running dealer groups, you know, expressing in public forums deep anxiety about their ability to justify their fees. And so, again, you know, it is about getting the service right and feeling confident that you're offering something of value. And managed accounts are a great contributor to that. So we've talked about investment fees being more sustainable than sort of strategic advice fees, and so we'll move on. Pricing that supports your positioning and values. There are any number of potential positions that you'll take for your business. My only point here is that pricing should support that. There shouldn't be any friction. I'm a huge believer in putting your advisors in a situation where they can sit upright and proud in front of a client and tell the story of your organisation, what it stands for, the value it can deliver, and when the client says, well, and how will I pay for that, that they don't, there's not that hint of sort of fear or lack of confidence as the voice drops when all of us, oh yeah, but, you know, there is a, you know, we're using some of our own products, or there's an asset, there's a, you know, a clip on the transactions or whatever. It takes away from the story. Don't make it harder for them, make it easier for them. Now, easy for me to say, but as I say, I have been through and done this. I've been through all the pain of all those negotiations and the internal discussions and the things you have to do to make it work, and believe me, it's worthwhile. But you don't want any friction. It's like the princess and the pea, you know, those things just eat away in the background, not just on the client, but on your staff. And so having a great fee story that suits your positioning makes your organisation so much more effective. Pricing that sends price signals. You know, what do you want your clients to do? And the best way I can talk to this is to give an anecdote that, you know, when we were looking at pricing and thinking about these issues, you know, for the first time for me in a significant way, and rolling out managed accounts, and that's going back sort of 4.5 years ago, I suppose, with thinking about this very question. And the orthodoxy at the time was that managed accounts were a premium product. And there was even this sort of idea that, you know, clients with, you had to have $500,000 to invest in a managed account. And so you would charge more for this premium service and people would feel, you know, kind of a bit special about having it. We looked at it and we said, you know what, that actually just makes no sense at all. Because what we're wanting them to do is to move away from this world where we're having to generate statements of advice every time you need to do something, which slows you down, where the client doesn't value. There's maybe 2 pages in the whole document that they're interested in reading. And it actually is a drag on, you know, causes implementation leakage. The cost to the organisation of creating these documents is high, and they're massively inefficient to generate. So wouldn't you want to incentivise people to do the thing that saves you money and that generates a better outcome for them? There was no contest between the organisation and the client in this. It's do what's good for you and what's good for the company, and that is using a managed account that delivers efficiency, faster implementation for the client, easier to own for the client. So generating statements of advice should be more expensive, and there should be an extra fee attached to working that way, cheaper to do the thing that's good for the company and good for the client, which is what we did, and that was an important part of getting support for managed accounts. Now, you know, it doesn't mean that you actually have to find a price point below your existing way of operating. It means you can put up the price of your existing way of operating, and then for people to stay at their current price point, managed accounts is the easier choice to make. And it's just a pragmatic way of looking at it, but you know, all those planets do align. It's a consistent argument in my view. Pricing that limits conflict and aligns interest. We sort of talked about this before in a way, when we're talking about positioning. You know, clips on trades is one example. You can do it, but I have seen some providers out there in the market where the headline price is pretty cheap, but the clip on the trade is heavy, and I think that's a difficult thing, because at some point, even if the client doesn't sort of get that initially, ultimately when they start to see it, they think, yeah, this is kind of a bit tricky. And if every time you make an investment decision there's a ka-ching sound that follows, then that's also not really a great look, because then you're on the defensive when you're explaining why you were taking certain steps with the portfolio. Even if there was a separation of duties where the person making that decision, you know, has no bearing on their decision. You've just created an objection or a doubt in the client's mind, and you create an issue for the staff that have to explain it. Now, again, easy to say for some people, that's the model they're running with, and moving on from that can be hard. But my personal preference is not to remove transaction costs at all. I think, you know, the perfect model is you charge at cost. If my broker charges this, that's what you pay. No clip to me, but I don't want to have an incentive to do it, but I also don't want to have an incentive to not do it. So you charge what the broker charges or what the platform charges, a straight pass-through. That's my personal opinion. Pricing that provides client choices. Look, you know, many businesses have a very simple pricing model. If your proposition is around simplicity, very simple service, you know, this is how we charge, and your clients are comfortable with that, there's no reason to change. But what I've found, and my experience has been a bit more in the high net worth end of the market, as pricing has become more transparent, that people are starting to look at it and go, gee, I hadn't quite sort of realised, you know, how much that adds up, you know, and then they start getting a little bit uneasy about the level of fees that they're paying. And I think it is a lovely mechanism to be able, rather than saying to them, okay, well, let's knock 20 or 30% off the price. What have you just done? You know, you've said it's worth less than what I was proposing to charge you. better to have a mechanism where you can say, well, we do have some levers we can pull. So, for example, if you are happy with passive investment management, we'll give you active asset allocation, but rather than paying many active MERs, we're all reading about, how that's a kind of a zero-sum game, or, the majority of managers can't achieve out of that. Well, we could go with ETFs and lower fee to you. And we're not having to research those managers in as much detail, so we'll drop our fee as part of that a little bit as well. And it might be, 10 points or something, you drop the fee. They feel that they're giving up a little bit, but they're getting a cheaper fee. Now, my experience is most clients, when presented with that option, choose not to take it, but they feel better that they've got it. And so, okay, if I want to control my pricing, I can. I do have some levers I can pull. You've been flexible, and there's a rational reason behind those choices. And so people can sort of leave the meeting feeling a bit good about it, rather than walking out thinking, I've just been told take it or leave it. And I don't think you ever really want to say to a client, take it or leave it. It's not ideal. The clients that perhaps you don't want, that you say that to. Pricing that enhances the value of your business. So one-off advice, one-off revenues, we've talked about that, one times multiple. So I don't think we need to dwell on that, but the point I will make here is that some of you will have internal remuneration structures where your advisor has traditionally taken the advice revenue and you take the platform rebate or the investment management element of it, and you say, well, that's that clear separation. And then you come to the introduction of managed accounts and you say, well, we'll just sort of continue that broad dichotomy. I don't think it works. I don't think it works, because the strategic advice part is point in time, it's occasional. I think what you need to do, in my view, is that you separate out the notion of strategic advice, investment planning, and the portfolio management aspects, and that the advisor is the person who does the investment planning work, who sets up that relationship, and that they should be, and you're looking to maximise these fees that get the higher multiple, so you should be happy. You want them to be an ally in sort of reducing the amount of revenue that really comes from strategic advice and increasing the amount that comes from investment-related activities. How do you do that? Well, if you say to them, we'll sort of leave you with the diminishing revenue stream, of course no one's going to be happy with that. So you've got to bring them on that journey, and you've got to bring them on that journey compliantly. And so and I'm not an expert in conflicted rem, but profit shares and other things that will pass through those tests, but you want the advisors to feel that if you've got new initiatives happening in the business, that you're pursuing a certain direction, they want to be in that boat. They don't want to feel that they're somehow being left to the side. I don't think that works well for success, because at the end of the day, it's your advisors who are going to sell and manage this. Pricing that's easy to administer. The industry is not good at managing, tracking revenues and things by and large, and I think this is one of the things that's really driven the success of platforms. And I think here, if you're running a managed account with a platform involved, the platform again can be a great ally in this. So you need to know, when you're designing your pricing model, okay, we've worked out the calculation. Who's going to do it? Who's going to levy it? Is it going to be something that's quick and easy and timely to calculate? You start bringing performance fees in, that quick and easy goes out the window. How will this revenue be tracked and reconciled? Am I creating a potential credit issue here? I don't think, want a pricing model where you're issuing invoices and things to people. You want to be able to debit straight out of client accounts. How long, if your platform's collecting this, how long are they holding this for? Do you have counterparty issues being created? Prudence says you've got to look at all these things and think about the risks that come from it. Do you have to create funky structures to make the revenue flow compliant? Do you have to set up separate businesses from the advice business and all this sort of thing? how does that look in the client's eyes? You know, before you settle on your pricing, you've got to have all these pieces mapped out and feel comfortable about it. Okay, so, but you know, flexibility at the platform level to charge different styles of fees that are clearly discernible to the client is a huge asset in this particular area. Funding the costs of managed account services. This is about margin probably more so than pricing, but you know, what your pricing model is today may have a significant bearing on what you can set up for the future, because if you've been using managed funds exclusively with relatively high MERs, platforms, you know, where you've been charging, you know, 50, 60 bips and keeping a significant rebate, those sorts of things, you've got lots of room to move in this new world as you pass through naked platform pricing and start using more direct securities, etc. But if you've been using mostly direct and your platform use has been minimal, or you've been, you know, rebating fees and things, bringing in the incremental cost of the managed account is a dilemma, you know, and so, you know, how you'll be able to manage your new pricing structure and making it acceptable to your clients, you're going to have extra challenges involved in that. So where you come from matters, and that's just a reality. What I will say is, in terms of margin, is use the introduction of managed accounts to find efficiencies in your business. It can be transformational. Don't be passive in it. Don't, you know, I like the ultimate use, or the optimal use of a managed account to me is a full-blown service where you re-engineer your business around it, and if you can take a lot of costs out of your business if you do it well, and that will fund you know, a number of the other new costs that come in terms of actually paying for someone to administer a managed account. So a couple of slides to go. In terms of broad implementation advice, I hope the message comes through that it's not like there are 2 or 3 pricing models that, you know, in the pricing manual, and you look at them and go, gee, I like the second one, bang. You actually have to design it for your business, and it should reflect what is unique about you, and it's part of telling your story. It doesn't have to look, you know, hugely complex at the end of the day, but it's all about lining the ducks up and having every aspect of what you do should reinforce each other, and you don't want pricing pulling on that and going in a different direction. Consult widely within your business. Talk to your staff, talk to your advisors, talk to your directors, you know, be transparent about it. Get the issues on the table. There are many managed accounts in this industry. There are very few that have achieved significant scale and success. A personal theory for that, around why that is so, is that there's passive resistance out there within people's own organisations that they don't even know about, because people will say that service diminishes my role, or it threatens my future in the company, or it makes me look like a goose in front of my clients, or whatever it will be. And so if you want to remove passive resistance, you have a consultative process where you get the issues on the table and then you respond to them. If people have got valid points, you deal with them. You make the compromises, because what you want is success. You want this thing to grow. And, you know, failing to plan and deal with these issues can actually handicap you in ways that you will never, ever, ever understand, because people won't tell you. It's just sort of deemed a conversation too hard to have. It's my personal theory. Model the impacts. You know, we do this. Okay, what does it mean for this style of client, that style of client? How will they respond? What does it mean for the profitability of our client base? Does it create sort of new issues that we need to be thinking about and managing? Look at what it means for organisational profit, because, you know, you've got other costs coming in as well as a result of introducing managed accounts, so you need to look at the big picture. Formalise the pricing model. It's got to be written down. In my case, we created a calculator And, you know, the story was this will never be seen by a client because that will sort of, you know, overly complicate the process. As it turned out, it was actually pretty positive using it in front of a client because they could see there was a discipline there, and they could also, there were the levers to pull if they wanted to change their pricing. So we built a model and it meant there was great consistency in terms of application. Build the story and rehearse the story. You know, how does each stakeholder win out of this? What are the benefits that you've created through this new service with this new pricing model? Monitor rollout is absolutely critical. This is the tough bit. This is where the rubber hits the road. Advisors sitting down, having conversations with clients. It is the hardest part of their job, I'm sure many advisors would say, and you need to support them, and you need to be pretty strong through that process because there's always a reason why a pricing model shouldn't apply to a particular client. And how do you manage that and you know, help people move through that process? And it's tough. That is the toughest part. As a general principle, if you can't get there in one step with clients, our experience is get there in a couple. You know, so well, we're agreeing that in 2 years' time we'll be at this point, but let's do it in stages. And you know, you get to experience the service, and you know, you've got this new service coming in. You know, we think you're going to like it. We think you're going to, you know, really acknowledge the benefits of it, but you won't pay at the full rate for a couple of years, and you know, by then you'll have, you know, the proof will have been in the pudding. You've got to be confident about what you're delivering. So, conclusion, introduction of managed accounts. It's a great and appropriate time to revisit your pricing models. Be very clear about the full set of goals you're trying to achieve. Be prepared to sort of start with a clean sheet of paper if you need to, and you know, plan, test, adjust, monitor. You know, it is something that rewards a lot of diligence and a lot of focus ultimately, because you know, once you're through that process, you've set your business up for the future, and you know, if the service is designed right, you're delivering something to your clients that they will value for many, many years to come. So I'll stop there and hand back to Toby to take us through any questions.
Great, thanks very much, Brett. Now let me just see if I can figure out how to unmute everybody. Where are we? Muted us. Yeah. Aye. Aye.
And the mouse over, that's the key.
Yep. Okay. Look, there are there any questions from the room or from the well, the ether?
Brett, I might kick off for everybody. What we studiously avoided discussing this morning was fees, which around not how you construct them, but what you think would be a reasonable tolerance for an advisor to charge a fee for implementation. Because it seems to me when an advisor charges that, the cost will go up unless the cost comes out somewhere else within the chain. And I wasn't clear on that as to what market acceptance on that would be. And I ask you to consider that changing the MER in a portfolio might change the index is not an acceptable response, because you can do that without a managed account and reduce the portfolio cost itself. On a like-with-like basis, who charges less to enable the advisor to charge more?
Well, again, as I say, it depends on where you're coming from. For some people are going to struggle with that, but generally speaking, people charging less on the platforms, and we've already seen a sort of a move down, and invest. So, you know, let me answer it this way. You're thinking about the conversation with the client and their acceptance of the fee. And the thing that I have looked at very closely in the past is total cost to client. So what have you been paying? What will you be paying in the future? In the client's mind, do they care How much has been going to the platform versus the advisor versus the investment manager? Not so much. It's about, what am I paying in total? Sometimes a bit of an uncomfortable conversation because people aren't really sure the client really understood every aspect of what they're being, notwithstanding disclosure's been there and been done properly and all of that, but people doesn't necessarily register. So where has who's been getting paid less in that mix? It's been the investment manager, it's been the platform by and large, getting paid less.
Ian, it's Toby here. If I can suggest a couple of the levers that we are using in our own business. One is that the offering a managed account service enables an advisor to move the service offer discussion away from I do this and then I hand it all over to somebody else. So it makes the advisor's service offer appear more integrated into the total client outcomes. We find that valuable. Some of the other practical things we've done or are in the process of doing have been to use the fact that an investment manager will be part of our portfolio models and therefore has a more reliable flow of funds as a way of getting active management outcomes at lower costs than would be achieved if it was every advisor for him or herself.
So what do we charge?
Well, I think that there is no magic number. I sort of resist that answer because it depends on the service you're providing, and the spectrum of services is incredibly broad.
What is your experience?
That's another way of asking the same question. Look, I think you add up what people have been paying historically. In many cases, have been paying 300 bips or more when it comes to you roll up the investment management platform, advice fees, etc. The way I look at it, my personal view is I always look at fees as a share of the risk premium. And so if you say a balanced portfolio has a risk premium that might be 3 or 4%, growth portfolio might be 4 or 5, and then the industry says we want to take out of that in fees more than half of the return, but we don't bear the capital risk. My personal view is that's too much, and so it's what will the market bear? I'm jousting with it here by saying, well, what should it be? And I think that the answer is it's ultimately you've got to try and get it down to sub 1.5, and recognising that you're providing value beyond the investment returns and things as well. But I think that's going to take some while. But for the advice component, for that investment planning element, putting aside whatever fee you might get, at points in time for the strategic advice, 50 to 70 bits rolled up with. I'm rolling it up with the portfolio management decisions on the managed account.
So implicit within this is an expectation. Investment management costs go down. From an industry participation, I don't think that's happening personally.
Well, again, it's not that any given manager's fee may drop. It's that if you've been using managed funds more and you can start to introduce more use of direct securities, then the cost of the client is falling. That's what they care about, but you're actually accessing a form of investment management where market forces suggest you can probably get a cheaper fee.
Yeah. Now, are there from the attendees out on the internet? Are there any particular questions? Are there other questions from the room?
Yeah. Wouldn't it mean that where you're using an international manager, for example, paying 1.5 plus or 2%, whatever it might be, you'll try to start looking at bundling different types of ETFs. And that would be one way to cut the costs down.
Yeah, option with or without a management account.
Yeah. So that would be one of the savings, but once again, it's the education to the client while you're doing it.
Yeah, I think Brett's point in terms of, so Ian's point was you might be able to do that regardless of a managed account. The reality is starting to use ETFs across a broad client base creates implementation issues, which the managed account is designed to address.
Yeah, there's a lot of costs that aren't maybe being considered around admin, back office support inside an advice business that I'm sure that a managed account can be made more efficient. So while it's not coming off any headline fee that the client may see, the advice business as a operation is definitely, well, I hope, will provide some internal benefits from a pricing perspective.
I agree with you. I think as an industry it's an important issue because what you're really saying is in implementation of a managed account, you get process efficiency and back office and lower costs. So there's the profit, there's the EBIT. But everybody seems to focus on this imagination that it'll cost less to the client from introducing a managed account. And I don't see anywhere where that really happens. I think it's a neutral position, but a much better way to run a business. Well, much more efficient. Yeah. The profitability of the implementation, all of those factors, goes from the EBIT of the practice or the vehicle. So that's where the profit goes. It's a good thing.
Yeah, no, that is a good thing. And as I say, my experience is, and again, it depends on, the sort of advisor to client, advisor to support staff ratios and all sorts of things. But my experience is that it can be absolutely transformational for the economics of an advice business. So it's not just theory, done it, and absolutely transformational for the profitability. But you've still got to get the client to buy. And so, turning up and saying to them, I've got a new service and a new pricing model, we're going to move to, remember we talked about sustainability as well. You want to sort of, you don't get too many chances to change the pricing model. If you want to change the pricing model and change nothing else, you're making your job harder. So at that point, you're changing the fundamental service is a great time to change pricing. And then, if you're happy with where your pricing is, then, you may just be arguing for equivalence, and that's fine. And as I say, you might even be charging a bit more in the future for the old way of doing business as an incentive to change. But if you're not happy with current pricing, then you may even be wanting to increase it. And that's my experience, was actually increasing the fee, delivering the service, changing the basis of it at the same time, and delivering changes in the economics of the business in terms of its internal costs. So doing all of those things at once, that is a challenge, but it can be done. But it was really having the managed account offer that provided the story to make all of those things happen.
So the value proposition then was enhanced because the services that you're providing were now going to be in a different way, or different types of services than what it was previously.
Yeah, I mean, and look, you think about, we're winding the clock back. We've just had a few very good years in markets. Going back 4 or 5 years, people were still smarting post-GFC. And so, having a service where you can manage portfolios more dynamically, where you can have an asset allocation overlay that might be separate to your manager's selection, where you can reduce implementation leakage, where clients who, might have been overseas or whatever and it got really busy in trying to contact them to get authorisation for changes, but all that can just be done for them. There's a lot of positive elements to that story. And so in my situation, it coincided with probably a more active investment management style coming through as well. But that may not be the case for you. You may be saying, no, I just want to deliver my investment management. I'm happy with it. I just want to deliver it through an easier to administer model. But if you're not happy with your investment management, do that too. Fix that at the same time. It's part of the whole story. As I say, it's a function of where you're coming from.
And my question's a little bit to the left of there. With the modern platforms not the traditional platforms, but the new modern platforms. My understanding, one of the real benefits of an MDA now is that you can actually start streaming risk insurance details in to give a far more complete picture. And that then means you're getting so much more efficiencies, and in particular with the technology that allows clients to look and see what you're doing. So I would have thought that would be another benefit of looking at it as well, not only the investment side, but the holistic look of the client when the streaming from, like, I think TAL's coming on later on this year. I mean, the AIA do it, Zurich do it, I think Astron's getting ready to do it. So that means for the first time you'll be able to have this inclusive arrangement instead of very costly updating and all that kind of stuff. So part of the whole fee structure, part of that message might be a way of explaining what's going on.
Yeah, and I haven't thought of that, to be honest, but yeah, if you've got some other service elements that are new and coming through and you can package them up with the service, then that would add to the story. But no, I hadn't thought of it.
Right, look, thank you very much. We might wrap it up, and thank you for joining